Welcome, everyone. I'm glad you're here today. Today, we're going to explore a fascinating and important topic: money and credit. This is the cover slide, so I just want to briefly introduce what we'll be covering. We'll look at how money works, the role of credit, and why these concepts are vital in our everyday lives. I'm excited to get started, so let's dive into the world of money and credit. Let's begin by understanding what economics is. Economics is the study of how individuals, businesses, and governments make choices about allocating resources to satisfy their needs and wants. It helps us understand the functioning of markets, the role of money, and the importance of financial institutions. Now, moving to the main theme of our presentation: money and its role in the economy. Money is a medium of exchange, a store of value, and a unit of account. It simplifies trade and makes transactions more efficient compared to barter systems. Speaking of barter, let's recall that barter system was the earliest form of trade where goods and services were exchanged directly. However, barter had limitations, such as the need for a double coincidence of wants, meaning both parties had to want what the other had. This brings us to the emergence of money, which evolved to overcome these limitations. Money can take various forms, including commodity money like cattle or grains, metallic money such as coins, and modern forms like currency notes and digital money. Commodity money was one of the earliest forms, where items like cattle or grains served as a medium of exchange. However, these had limitations, such as difficulty in portability and divisibility. Over time, metallic money was introduced, offering durability and ease of use. Coins made of metals like gold and silver became common, representing a significant step forward. Later, money evolved further into modern currency, which is primarily issued by the government and central banks. These are called legal tender. Other names of modern currency include notes and coins recognized officially. Now, let's discuss the importance of different types of money and currency. Money can be anything that is widely accepted as a medium of exchange. Modern money exists in various forms, including coins, notes, and digital forms like e-wallets. In addition to physical money, the banking system plays a crucial role. Banks provide various deposit accounts, such as savings, current, and fixed deposit accounts, which help in the proper management and utilization of money. Demand deposits are a modern form of money because they can be withdrawn on demand, facilitating smooth transactions. The main function of banks is to accept deposits, lend money, and facilitate payments through instruments like checks. Checks are essential banking instruments. They have specific features, such as being a written order to pay a certain amount from one account to another, and require essential components like the date, payee's name, amount, and signature. Now, let's look at the sources of credit. Formal sources include banks and financial institutions, while informal sources involve family, friends, or moneylenders. Both serve different needs, but have their own advantages and limitations. In particular, informal credit sources are often used by small farmers and informal sector borrowers because they are more accessible and flexible, but they also pose risks, such as higher interest rates and lack of regulation. To protect borrowers in the informal sector, measures like self-help groups and cooperative societies have been introduced, helping small borrowers access credit at reasonable rates and with better terms. Cooperative societies, in particular, play a vital role in capital formation and providing credit to their members, especially in rural areas. These societies are democratic organizations working for the benefit of their members. Finally, understanding the role of credit in development is crucial. Credit helps in increasing production, improving infrastructure, and fostering economic growth, especially in developing countries. So, in summary, money has evolved from barter to commodity money, metallic money, and now to modern currency, with financial institutions like banks playing a key role. Credit, both formal and informal, supports economic activities, and cooperative societies help in capital formation. All these elements are interconnected and vital for a healthy economy. You've probably never thought very much about money. It is just there. When you want or need something, you simply collect some money and pay for it. That wasn't always the way things were done. Would you not like to know about how money has come? In this chapter on money and credit, we're going to explore the fascinating history and evolution of money. It's interesting to consider that, for most of history, people relied on barter systems, exchanging goods and services directly. But as societies grew more complex, the limitations of barter became clear. Things like the double coincidence of wants, where both parties had to want what the other had. This led to the development of money as a medium of exchange, something widely accepted that could stand in for goods and services. We'll look at how money evolved from simple shells and grains to coins and paper currency, and eventually to digital forms today. Understanding this history helps us see how integral money has become to our economy and daily life. It also sets the stage for understanding modern credit systems and how they shape our financial world. Studying about money and credit helps us make wise economic decisions, such as how we allocate our resources, invest wisely, save effectively, and manage our expenditures. These decisions are crucial because they directly impact our financial well-being. To earn economic wealth, managing money is just as important as earning it. Without good money management skills, even earning a lot of money can be ineffective in building wealth. Remember, money is the tool through which we measure many aspects of our financial lives. How much we earn, how we spend, what we lend or borrow, how much we save, and even how much we donate. It's a universal language of financial activity. All of us aim for a good income in the future, which is naturally measured in terms of money. That's why understanding money and credit is essential. They help us achieve our financial goals and secure a better future for ourselves. Let's move on to slide 5. Here, we focus on the sources of credit and conduct a critical analysis of them. Understanding where credit comes from and evaluating these sources is essential for grasping the broader financial system. We'll examine different modern forms of money, exploring their features and roles in the economy. We'll also look into the terms of credit, what they are, how they influence borrowing, and their significance in financial transactions. Additionally, I'll highlight the role of cooperative societies and self-help groups in capital formation, emphasizing their importance in fostering financial inclusion. This slide ties into our overall theme by showing how various credit sources and forms of money contribute to economic growth and stability. Recognizing these elements helps us appreciate the complexity and interconnectedness of our financial system. There was no need for exchange and money in the primitive age. Back then, people's needs were very limited, and they could easily gather everything they required. They collected food to eat and used the skins of animals and plants to wear. Everything was naturally available, so there was no concept of trading or using money. This simple way of life worked well for them because their needs were minimal. As society evolved, though, so did the way we handle transactions. That's when money started to emerge as a solution to make exchanging goods and services more efficient. So, understanding this early stage helps us see how money became an essential part of our economic systems today. Let's imagine that students will be discussing this among themselves, with some help from the teacher, and they will realize an important fact. Every activity in today's world is impossible without money. As civilization grew, people's needs also increased. Initially, individuals who were skilled at producing certain goods began to see these as their profession. They would produce specific items and then exchange them with others for what they needed. For example, someone making stone tools might trade those tools with a hunter in exchange for meat. This kind of exchange is what we call barter. It's an important step in economic development because it shows how people started trading goods directly. But as needs became more complex, barter had its limitations, like matching what each person wanted. So the key point here is that barter led to the emergence of exchange systems, which eventually evolved into using money as a more convenient way to facilitate trade. This development was crucial because it laid the foundation for the modern economy, where money makes transactions smoother and more efficient. So, in essence, every activity we see today, whether buying, selling, or trading, starts from this idea of exchange, which originally began with barter. Today, I want to talk about a very basic form of exchange called the barter system. Essentially, it's a system where commodities are exchanged directly for other commodities. Now, what's important here is that no money or medium of exchange is involved in this process. Instead, people trade goods they have for goods they need, based on mutual agreement. This system relies heavily on the double coincidence of wants, meaning both parties must want what the other has to offer. For example, if a farmer has wheat and needs shoes, they must find a shoemaker who wants wheat. While the barter system was common in ancient times, it has limitations, especially as economies grow larger and more complex. Still, understanding this system helps us appreciate the evolution of trade and the importance of money as a more efficient medium of exchange. So, in our overall discussion of economic systems, the barter system is a foundational concept that shows how people initially exchanged goods before the development of money and more advanced trading methods. On this slide, we see the main features of the barter system. First, there's no common measure of value, which means that goods and services weren't easily comparable or standardized. This made transactions more complicated. The barter system relies heavily on a double coincidence of wants, meaning both parties had to want what the other had to offer, which could be quite limiting. Importantly, there was no use of money or any other medium of exchange. Everything was exchanged directly. Goods or services were swapped directly for other goods or services, making it a very straightforward but sometimes inefficient system. This system is actually the oldest form of exchange used by humans, and understanding its features helps us appreciate why the evolution toward money and more advanced systems was so necessary. It sets the foundation for the development of more sophisticated economic exchanges. Low transaction time is required, which means transactions can be completed quickly and efficiently. This helps people avoid the risk of changes in value over time, so they don't have to worry about prices fluctuating before the deal is done. No medium of exchange is needed in this system, since goods or services are exchanged directly. It's a straightforward, immediate process, satisfying needs right away without involving money. This is what we call a direct exchange system. The key advantage here is the immediacy. Needs are met instantly, making barter a simple and efficient way to trade, especially when both parties find what they need right at that moment. This ties into our overall theme of alternative trading systems, showing how barter can be practical and effective without relying on money. Now let's look at some of the limitations of barter, which was one of the earliest systems of exchange. First, deferred payment was not possible, meaning you couldn't pay for goods or services at a later date, making transactions less flexible. Then, there's the problem of divisibility. Some goods can't be divided into smaller units without losing value, which complicates exchanges. Another key issue is the problem of transferring value. For example, if you want to trade something valuable for a less valuable item, it becomes difficult to ensure fair exchange. This ties into the lack of a standard measure of value, which makes it hard to compare different goods and services accurately. Storing value is also problematic. Goods may spoil or become obsolete over time, so saving wealth in barter isn't practical. Lastly, barter requires a double coincidence of wants, meaning both parties must want what the other has at the same time, which severely limits trade opportunities. All these limitations highlight why barter, while historically important, had significant constraints that led to the development of more advanced monetary systems. To practice barter, there must be a double coincidence of wants. That means both parties need to want what the other has to offer. For example, in this case, there is a potter who makes pots and wants to exchange his pots for some clothes. He visited all nearby cloth makers, hoping to trade his pots for clothes. But none of the cloth makers were willing to give clothes in exchange for pots. Instead, they wanted something different, maybe grains or other goods, something that they valued more than the pots. This highlights a key problem with barter, which is the need for a double coincidence of wants. Both parties must want exactly what the other has, at the same time, and in the right quantities. This requirement makes barter less efficient and more difficult, especially in larger or more complex economies. And this challenge is actually one of the reasons why money was eventually introduced, to solve this problem. By using money, people no longer need to find someone who wants exactly what they have. They can sell what they have for money and then use that money to buy what they need. Let's talk about the most primitive form of money, which is commodity money. Essentially, this is when a useful commodity that is in general demand is used as a medium of exchange. Now, what's interesting here is that such commodities can serve dual purposes. They can be used as a means of payment and also as a measure of value. For example, in ancient times, items like shells, salt, or even cattle were used because they were valuable and widely accepted. This form of money is fundamental because it laid the groundwork for more complex monetary systems we see today. It highlights how people initially relied on tangible, valuable objects to facilitate trade and establish value. So, understanding commodity money helps us see the roots of how money evolved to become the more abstract forms we use now. Let's talk about the concept of split barter, a term Riegel used to describe a particular kind of transaction. Essentially, it still involves a barter trade, meaning you're exchanging one good or service directly for another. For example, you might trade cattle for sugar or grains for nails. This kind of exchange is still rooted in the barter system, where goods or services are exchanged directly without using money as an intermediary. Historically, various commodities have served as money, acting as a medium of exchange before modern currencies developed. These include items like cattle, tobacco, sugar, grains, nails, shells, hides, metals, and many others. Today, we recognize that many of these commodities played a crucial role as money in different societies. They helped facilitate trade and economic activity long before we had the standardized currency systems we use now. Understanding this history helps us see the evolution from commodity money to the more abstract forms of currency we rely on today. Now, let's talk about some of the limitations associated with commodity money. First, there's a problem with storing value. Unlike money today, which can be stored easily and safely, commodities like grains or gold can be bulky, perishable, or difficult to keep in good condition over time. This makes storing value a real challenge. Next, deferred payment becomes problematic. Since commodities can fluctuate in value or spoil, it's not always practical to agree on future payments. This limits how we can use commodity money for credit or loans. There's also the issue of transferring value. Transporting physical commodities can be inconvenient, expensive, and risky, especially over long distances. Another key point is the lack of a standard measure of value. Commodities don't have a universal unit, so it can be tough to compare values accurately or to make precise transactions. Plus, commodity money requires a double coincidence of wants. That means both parties must want what the other has at the same time, which makes exchanges more complicated and less efficient. All these factors highlight why commodity money, despite its historical importance, has several significant limitations. It's these issues that eventually led to the development of more advanced forms of money that are easier to store, transfer, and standardize. So, to solve the problem of transfer of value with commodity money, people began to use cattle as money. You see, domestic animals that had common utility, meaning they were useful in everyday life, were chosen as a medium of exchange. These animals, which served practical purposes like farming or transportation, became known as cattle money. This was an important step in the evolution of money, as it helped facilitate trade and exchange in a way that was more manageable than simple barter or raw commodity money. It highlights how societies adapted their monetary systems based on the resources they had readily available. Now let's talk about cattle money. When we refer to cattle money, we're looking at the financial aspects tied to the cattle industry, which is a significant part of agriculture and rural economies. It's not just about the sale of animals. It also involves understanding market fluctuations, costs of production, and potential profits. One key point to highlight is how cattle prices can vary based on supply and demand, seasonal factors, and broader economic conditions. These price swings can have a direct impact on ranchers' bottom lines. Another important aspect is the cost of raising cattle, things like feed, healthcare, land, and labor, all of which influence the overall profitability. Managing these expenses effectively can make a big difference in how much money cattle operations generate. Connecting this to the overall theme, understanding cattle money is crucial because it underpins the sustainability of the industry. It affects decisions about herd size, investment in infrastructure, and even the future of rural communities. Recognizing these financial dynamics helps us appreciate the complexity and importance of managing cattle operations wisely. Let's talk about some of the fundamental problems with cattle money. First, there's the issue of divisibility. Cattle can't be easily divided into smaller units, which makes transactions complicated when dealing with smaller amounts. Next, storing value is a challenge because cattle require specific conditions to keep alive and healthy, making them less practical for saving over time. Deferred payment also becomes problematic, as you can't easily agree to pay later when the value isn't easily divisible or storable. Transferring cattle from one person to another poses its own difficulties. It's not as simple as handing over some coins. There's also no standard measure of value with cattle. What one person considers valuable might differ from another, leading to inconsistencies. Plus, for a transaction to happen, both parties need to want what the other has, what we call the double coincidence of wants, which isn't always easy to find. Specifically, when it comes to cattle as money, these limitations become even more apparent. They highlight why societies eventually moved toward more standardized, portable, and divisible forms of currency to facilitate trade smoothly. All these points underscore the need for better money systems that address these issues and support more efficient economic exchanges. Now let's talk about metallic money. These coins and bars are quite convenient because they can be easily carried from one place to another. They are also simple to store, and importantly, they don't get damaged easily. This durability made them very practical for everyday use. Some precious metals, like gold and silver, which also had common utility, started being used as a medium of exchange. This means they became a standard way for people to trade and settle transactions. These are what we call metallic money. So, in essence, metallic money played a crucial role in the evolution of our financial systems, making trade smoother and more reliable. It's a key step in how we moved from barter to more advanced forms of currency. So, this slide highlights how the concept of value has been measured in different ways over time. It gives us a standard way to understand and compare the worth of different items or currencies. Early on, people started adding symbols to represent value, which was a significant step toward more organized and recognizable forms of currency. And when we look at the evolution of money, it's fascinating to see how we moved from simple barter systems to these modern coins that incorporate symbols and markings, making transactions more straightforward. This development reflects our ongoing efforts to make trade easier and more efficient, tying into the broader theme of how money has evolved to serve our changing needs. Now, moving on to slide 21, I want to highlight how standardization plays a crucial role in the world of modern coins. When we say coins are standardized with weight, size, and color, it means that there's a consistent approach across different types and denominations. This consistency helps people easily identify and verify coins, which is essential for smooth transactions. It also reduces confusion and potential fraud. Standardization ensures that whether you're in one country or another, coins are recognizable and trustworthy. This is a key part of modern minting practices, connecting directly to the overall theme of how coin design enhances functionality and security. Now let's look at how the materials used in coinage evolved over time. In the past, precious metals like gold and silver were common for making coins, but they were quite costly. As a result, many societies started replacing these expensive metals with less costly alternatives. This shift allowed for more practical and widespread use of coins, especially as economies grew and the demand for currency increased. So, when we think about the development of modern coins, one of the key steps was this move toward using more affordable metals, making coins more accessible to everyone. This change not only helped sustain the economy, but also marked a significant step toward the more practical and durable currency systems we use today. So, when we talk about money, we're referring to anything that serves as a medium of exchange, a store of value, a measure of value, and a standard of deferred payments. Essentially, money is the tool we use to facilitate transactions, to hold value over time, and to compare the worth of different goods and services. It also acts as a standard that allows us to agree on the value of future payments. These functions are fundamental because they make economic exchanges more efficient and reliable. Understanding these key roles helps us grasp why money is such a vital part of our economic systems and daily lives. Let's explore some of the key functions of money. First, money is used as a standard of deferred payment, which means it allows us to buy now and pay later, making transactions more flexible. It also serves as a way to store value for future use, so you can save and use it when needed. Another important role is transferring value from one person to another, or from one place to another, facilitating trade and commerce across distances. Money is also used to measure the value of goods or services, giving us a common standard for comparing worth. It functions as a medium of exchange, which is probably its most recognized role, making trade smoother and more efficient. Because of these roles, money has purchasing power, meaning it can buy goods and services. And here's a crucial point. Money can be anything that serves these functions effectively. It's not limited to coins or paper. In fact, throughout history, many different items have served as money. So the key takeaway is that money is fundamentally about its functions, not just its form, and it can take many forms depending on the context. Today, I want to talk about the medium of exchange, which is one of the fundamental functions of money. When we say medium of exchange, we're referring to how money is used to facilitate the buying and selling of goods and services. Essentially, money acts as an intermediary that makes transactions smoother and more efficient. Without a medium of exchange, we would have to rely on barter, which can be quite complicated and inefficient, especially when trying to match what each party has to trade. Money simplifies this process because it's widely accepted and recognized as a standard form of payment. This function ties directly into the overall theme of money's role in our economy. By serving as a medium of exchange, money helps to promote economic activity, supports trade, and allows us to focus on producing and consuming rather than on finding someone who wants what we have and has what we need. So, in summary, the medium of exchange is what makes money incredibly valuable. It's what allows us to carry out transactions quickly, easily, and efficiently, fueling economic growth and development. Let's talk about the store of value function of money. Essentially, this means that money can be saved and stored for future use. Instead of spending immediately, you can hold on to it to make purchases later on. This function is crucial because it allows individuals and businesses to plan ahead, save for big expenses, or even just keep some wealth in a liquid form. Now, when we link this to the overall theme of money, it highlights how money isn't just for transactions today. It also acts as a way to preserve wealth over time. That's what makes money so versatile. It's not only a medium of exchange, but also a reliable store of value. Think about how people save in banks or keep cash for future needs. That's the essence of this function. It provides stability and confidence, knowing that your money retains value until you're ready to use it. This is a vital role that underpins economic stability and personal financial planning. Let's now take a closer look at the functions of money, which is a key aspect of its role as a measure of value. When we talk about the functions of money, we're really exploring how money facilitates economic activity and makes trade more efficient. One of the most fundamental functions is that money serves as a medium of exchange. This means it's what we use to buy and sell goods and services, simplifying transactions compared to barter systems. Another important function is that money acts as a unit of account, which means it provides a common measure to value goods and services. This helps us compare prices and make informed economic decisions. Lastly, money also functions as a store of value, allowing us to save and accumulate wealth for future use. These functions are interconnected and essential to understanding how money supports the overall economy. They highlight why money is so important. It not only facilitates transactions, but also helps us organize and plan economic activity over time. This ties directly into the broader theme of how money underpins economic stability and growth. Let's take a moment to understand the transfer of value, which is a fundamental aspect of money's functions. When we talk about transfer of value, we're referring to the process of moving money from one person or entity to another, often in exchange for goods or services. This function is crucial because it facilitates economic transactions smoothly and efficiently. Now, in the context of the functions of money, transfer of value is essentially what enables us to buy, sell, and settle debts. It's what makes money a medium through which value is exchanged, rather than just stored or measured. Without this capability, our economic activities would be much more complicated and less efficient. This ties into the overall theme of money, serving as a facilitator in our economy. It's not just about holding or measuring wealth, but actively using that wealth to transfer value across different parties and over various transactions. So, when considering the transfer of value, think of it as the heartbeat of economic activity, making sure that resources, payments, and obligations move seamlessly from one individual or organization to another. Now, let's talk about the standard of deferred payment. This function of money is really important because it allows people to buy now and pay later, which can help in managing cash flow and making larger transactions more manageable. Essentially, it means that money can be used as a measure for future payments, giving both buyers and sellers flexibility. This standard helps facilitate credit transactions, making it easier to engage in trade without needing immediate payment. It's a crucial element because it supports economic activity by enabling deferred payments over time, which is fundamental for credit systems and loans. In the broader context of the functions of money, this standard of deferred payment complements the other functions by providing a reliable way to settle debts in the future, contributing to the smooth functioning of the economy. RS1 and its subsidiaries are issued by the Ministry of Finance. It issues coins of RS1 and 50 paisa. Paper currency notes and metallic coins for denominations of RS2 and above are issued by the Reserve Bank of India, with the permission of the Finance Ministry of the central government. Currently, the Reserve Bank issues coins and notes in denominations of RS2, 5, 10, 20, 50, 100, 200, 500, and 2,000. The coins and paper currency, whether in paisa or rupees, are generally accepted as the medium of exchange or money in India. This is a key aspect of our monetary system, ensuring smooth transactions and economic activity across the country. Now, let's talk about why currency notes and coins are called token money. You see, their intrinsic value, what they're actually made of, is very little or sometimes nothing at all. Instead, they represent a higher value, which is agreed upon by society. That's why we refer to them as token money. It's essentially a symbol or a token that stands for value, rather than having that value in themselves. This concept is important because it helps us understand how modern currency functions in our economy. It's all about trust and the accepted value that these tokens stand for, rather than their material worth. Understanding this distinction helps us see how currency operates as a facilitator of trade and economic activity. Let's talk about why currency notes and coins are called high-powered money. Essentially, they are considered high-powered because they represent a higher value than their actual physical worth. In other words, the face value on the notes and coins is much greater than the cost of producing them, which gives them this high power, status. Now, moving to the next point, there are also other names for modern currency. These include terms like fiat money, legal tender, or government-issued currency. All of these highlight the fact that today's currency is backed by trust and government authority rather than physical commodities like gold or silver. Understanding these concepts helps us grasp how modern monetary systems operate, emphasizing the importance of trust and authority in the value of money. This is a key part of the overall theme of how money functions in our economy. Now, let's talk about the rupee notes and coins in India. They are called legal tender money because they have legal value. This means that no one can refuse to accept them as a valid form of payment. Essentially, if you're paying someone in rupees, they are legally obliged to accept it. This concept of legal tender money is crucial because it ensures smooth transactions and trust in our currency. It ties into the overall theme of understanding how our currency functions as the foundation of our economy. So, in summary, our rupee notes and coins are more than just pieces of paper or metal. They are recognized by law as valid and accepted for all payments. A bank essentially acts as a financial hub where depositors can safely store their money. And in turn, the bank uses those deposits to provide loans to individuals or businesses that need financial support. This process benefits everyone. Depositors earn interest on their savings, while borrowers get access to funds they might not have readily available. A bank is a financial institution that deals with money and credit as its regular course of business. It's not just about holding money, it's about facilitating economic activity by managing the flow of funds. So, in simple terms, banks accept deposits from people who want a safe place to keep their money, and they grant loans to those who need financial assistance. This cycle is vital for economic growth and stability. It's the backbone of our financial system, connecting savers and borrowers in a way that supports overall development. Now, let's take a closer look at some of the key functions of a bank. One important role is making payments on behalf of customers, such as paying electricity bills or insurance premiums. This service helps customers save time and ensures their payments are made securely and on time. Another vital function is providing safety for customers' valuables. Banks offer secure safes and vaults to protect valuable items and important documents, giving customers peace of mind. Banks also accept payments from customers, whether it's for utility bills, school fees, or other expenses. This makes managing finances more convenient for everyone. Granting loans is another crucial function. Banks provide financial assistance to individuals and businesses, helping them fund big projects, buy homes, or expand their operations. This supports economic growth and personal goals. Transferring funds between different places or accounts for customers is also a key service. It allows quick and safe movement of money, whether within the same bank or across different banks. Finally, banks accept deposits from customers, encouraging savings and providing a secure place to store money. All these functions work together to support the financial needs of individuals and businesses, playing a vital role in the economy and everyday life. So, when we think about the main functions of a bank, it all revolves around two key groups: borrowers and depositors. Borrowers are those who come to the bank to get loans, whether it's for buying a house, starting a business, or any other purpose. Depositors, on the other hand, are people or entities who put their money into the bank for safekeeping and to earn some interest. The bank acts as an intermediary between these two groups. It collects deposits from depositors and then uses those funds to provide loans to borrowers. This process is fundamental because it helps channel savings into productive investments, fueling economic growth. So, in essence, the bank's main function is to mobilize savings from depositors and allocate those funds efficiently to borrowers who need capital. This cycle supports both individual financial needs and the broader economy. Remember, the success of a bank depends on how well it manages this balance, ensuring safety for depositors while providing loans to borrowers. That's the core of what a bank does. Now let's take a closer look at the major types of deposits, starting with the fixed deposit account, which is also known as a time or term deposit. This type of deposit is withdrawable only after a specified period of time, so you need to plan accordingly. It includes deposits where you lock in your money for a certain duration to earn interest. Next, we have the recurring deposit account. This allows you to deposit a fixed amount regularly over a period, helping you build savings steadily. Then there's the savings account, a more flexible option that offers interest on your deposited amount and allows you to withdraw anytime, making it ideal for daily banking needs. Finally, the current account, which is mainly used by businesses, provides demand deposits. This means you can withdraw your funds at any time without any restrictions. Understanding these different deposit types helps us see how banks cater to various financial needs, whether for saving, investing, or day-to-day transactions. Rich businessmen and organizations often open these types of accounts. One key point to remember is that no interest is paid by the bank on deposits in these accounts. The main purpose of opening such an account is to provide safety for the customer's cash, ensuring it is secure. Additionally, there are no restrictions on withdrawals or deposits, which makes these accounts very flexible for the account holder. This type of account is typically known as a current deposit account, and it plays a vital role in the broader banking system by offering both safety and accessibility to funds. Understanding these features helps us see how banks cater to the needs of high-net-worth individuals and organizations, fitting into the overall theme of diverse deposit options. Let's talk about the savings deposit account. First, there's no restriction on how much you can deposit, which makes it very flexible for savers. The bank pays a low interest rate, usually around 3 to 4%, so it's not meant for high returns but for safety and liquidity. Small businessmen and people with low or moderate incomes often open these accounts because they offer a safe place to keep their savings. One of the main advantages is that you can withdraw your money at any time, although there might be some minor restrictions. This flexibility makes it ideal for meeting uncertain urgencies or unexpected expenses. Overall, the primary purpose of this account is to encourage savings and provide easy access when needed, fitting well into the broader theme of financial security and planning. Today, let's discuss the main purpose of a recurring deposit account, which is primarily to encourage capital formation and savings. The idea is that people set aside a fixed amount of money regularly, helping them build a substantial amount over time. One important aspect to remember is that withdrawals are only allowed upon maturity, meaning you can't access the funds before the agreed period ends. This type of account is especially popular among individuals with a regular income, such as salaried workers, because it helps them save systematically. Banks also offer attractive interest rates on these deposits, making it a good option for saving money securely while earning interest. In a recurring deposit account, a fixed amount is deposited at regular intervals, say monthly, for a fixed period. This disciplined approach not only helps in accumulating savings, but also instills a habit of regular saving. So, overall, recurring deposit accounts are a convenient and effective way to save systematically, earn good interest, and ensure disciplined financial planning. This connects well with our overall theme of understanding different deposit options for effective money management. Let's talk about the fixed deposit account. One of its key features is that it offers the highest rate of interest among deposit options. This makes it very attractive for those looking to earn more from their savings. Typically, people who don't have many other investment options and have specific future financial needs choose to deposit here. They are often looking for a safe way to grow their money over time. An important aspect of a fixed deposit is that withdrawal is only allowed upon maturity. This means you need to plan your funds accordingly, as early withdrawal isn't usually permitted without penalties. The main purpose of this account is to earn interest and save for future needs, whether it's a big purchase, education, or other expenses. In essence, you deposit a fixed amount of money for a fixed period, and in return, you receive a higher interest rate. This structure helps you plan your savings goals better, knowing exactly how much you will earn and when. So, in summary, a fixed deposit account is a secure way to grow your savings with a guaranteed return, especially suited for those with specific future financial plans. Let's talk about demand deposits and their role as a modern form of money. Essentially, anything that has purchasing power is considered money, and demand deposits fit right into this category. This means that when you have a demand deposit, you have money that you can use for making payments or purchases. You can access this money at any time through various means like checks, debit cards, or net banking. It's very flexible and convenient. The money stored in your demand deposit account can be withdrawn whenever you need it, whether through a check, ATM, or other methods. So, to sum up, demand deposits are a key modern form of money because they give you instant access and the ability to use your funds for transactions whenever you want. This flexibility and accessibility make demand deposits a fundamental part of our financial system today. Demand deposit has purchasing power. This means it can be used directly to make payments or to purchase goods and services. Because of this, we consider demand deposit as money. Remember, money is anything that has purchasing power, which allows us to exchange it for goods or services. Moving on to the next point, modern form of money. It refers to the types of money we use today that are more advanced and convenient. These forms include digital money, electronic transfers, and other innovations that make transactions easier. Understanding these concepts helps us see how money functions not just as physical cash, but also in various modern forms that facilitate our daily transactions. This ties into the overall theme of how money evolves to meet our needs in a changing economic landscape. A check is essentially a written document that a depositor uses to instruct their banker. It's a formal way to request the bank to pay a specific amount of money. The key point here is that the check can be made payable either to the person who wrote it, to the bearer, or to a particular individual. This flexibility makes checks a versatile payment instrument. Throughout this presentation, we're highlighting how checks play a vital role in banking transactions, offering a convenient alternative to cash payments. So remember, the core idea is that a check is a written order from the depositor to the bank, specifying the amount and the payee. A check is a modern form of money, and it's primarily used to make payments easily and conveniently. When you write a check, you're essentially giving an instruction to your bank to pay a specific amount of money from your account. It's a written order, and this order is directed to your banker. The check itself is a formal document, carefully prepared in a prescribed form by the bank to ensure accuracy and security. It's important to remember that a check is issued by the depositor, which means the person who has deposited funds in the bank, typically the account holder, and they are instructing the bank to transfer that money to someone else or to pay them. So, in essence, a check combines the convenience of modern banking with a formal, written instruction that makes transactions secure and reliable. It's a key feature of banking systems that facilitates smooth and efficient financial dealings. Now, when filling out a check, it's essential to include the amount clearly. This should be written both in words and in numbers to avoid any confusion or tampering. Next, you need to provide the account number of the depositor, which helps identify your bank account accurately. The name of the payee is also crucial, whether it's yourself, a bearer, or a third party. Specifying this correctly ensures the funds go to the right person or entity. Additionally, you'll need to include the date of drawing or making the check, which indicates when the check was issued. Finally, don't forget to sign the check. Your signature authorizes the transaction and confirms your approval. These components, amount, account number, payee's name, date, and signature, are the essential building blocks of a valid check, connecting directly to the overall theme of understanding banking instruments and ensuring secure transactions. Let's take a closer look at the different modern forms of money, starting with credit, which is essentially the trust you have in a financial system to allow you to borrow and repay later. Moving on to digital cash, this includes net banking and mobile banking, making transactions more convenient and accessible from anywhere. Next, we have bank money, which covers traditional instruments like checks, demand drafts, and banker's checks, tools that have been used for a long time to transfer funds securely. Then we come to card money, also known as plastic money, which includes debit cards, credit cards, smart cards, and even health cards. These are all forms of money stored electronically on a card for quick, easy access to funds or services. Overall, these modern forms of money illustrate how financial transactions are evolving, becoming faster, more efficient, and more integrated into our daily lives. They highlight the shift from physical currency to digital and electronic methods, which is a key aspect of the ongoing financial modernization. Let's talk about credit. Essentially, credit is an arrangement where one person or entity's financial needs are met using the resources or money of someone else. The key idea here is that this isn't just a gift or a donation, but there's a promise involved, a promise to pay back the amount borrowed in the future. This concept is fundamental because it allows individuals and businesses to access funds they might not currently have, helping to facilitate transactions, investments, and growth. It also ties into the broader theme of financial management and responsibility, because borrowing wisely and repaying on time are crucial for maintaining good credit and financial health. So, in essence, credit is about trust and future repayment, enabling economic activity and personal financial stability. All right, let's take a closer look at this slide. Here, we see a simple diagram illustrating the concept of credit. On the left, we have cash, goods, or services. These are the immediate exchanges we often think about. But then, we have the idea of a promise to pay in the future. This is the essence of credit. Think of it this way. When you buy something on credit, you're not paying right away. Instead, you're promising to pay later. That promise to pay is what makes up credit. It allows transactions to happen even without immediate cash exchange, which is crucial for economic activity. So, in essence, credit bridges the gap between immediate exchange and future payment. It's a fundamental concept that enables businesses and consumers to operate smoothly, fostering growth and liquidity in the economy. This idea ties into our broader theme of how financial systems facilitate trust and exchange. Credit relies heavily on trust that the borrower will fulfill their promise to pay in the future. Understanding this concept is key because it underpins so many financial instruments and transactions we deal with daily. Let's look at how credit plays a vital role in development. First, it helps lenders earn interest from their savings, turning idle funds into productive capital. This not only benefits the lenders, but also encourages more savings, fueling economic growth. Second, credit maximizes the use of resources by providing working capital to businesses and entrepreneurs, allowing them to operate smoothly and expand. Third, it enables borrowers to invest more than what they currently have available, opening doors for larger projects and innovations. And finally, credit makes proper use of the excess money held by depositors by channeling it into profitable investments. In this way, it helps maximize the country's overall worth by ensuring that money is used efficiently and productively. So overall, credit is a powerful tool that supports economic development by mobilizing savings, promoting investment, and optimizing resource use. Now, let's move on to some of the key terms of credit that both borrowers and lenders agree upon before a loan is granted. First, we have the documentation required, which is essential for establishing the terms and ensuring everything is transparent. Next is the mode of repayment, which outlines how the borrower will pay back the loan, whether in installments, lump sums, or other arrangements. Collateral is another critical point. It provides security for the lender in case the borrower defaults. Then there's the rate of interest, which determines the cost of borrowing over the loan period. Finally, these conditions can vary depending on the specific agreement, making it important to understand the different factors that influence the lending process. These terms of credit form the foundation for a fair and clear borrowing arrangement, aligning both parties' expectations from the start. When it comes to sources of credit, there are quite a few options available to individuals and organizations. These include traders, cooperatives, friends, non-bank financial institutions known as NBFIs, money lenders, family members, and of course, banks. Each of these plays a different role in providing loans or credit. Traders and cooperatives often lend credit within their communities or networks, sometimes based on trust and mutual benefit. Friends and family are also common sources, especially for small or urgent needs. NBFIs can include other financial entities that are not traditional banks but still offer credit options. Money lenders tend to be informal sources, often operating outside formal regulations, which can be risky but accessible. Banks are usually the most formal and regulated source of credit, offering a wide range of financial products. The key point here is that the person or organization granting the loan, whether it's a bank, a friend, or a moneylender, is essentially the source of credit. Understanding these different sources helps us see how access to credit can vary depending on the situation, the amount needed, and the level of formality. All these sources are interconnected as part of the broader financial system, which plays a crucial role in supporting economic activities and individual needs. Recognizing where credit comes from is essential for making informed financial decisions and managing borrowing responsibly. Let's take a closer look at the sources of credit and their key characteristics. Starting with informal sources, these typically require no or very little documentation, making the process quick and simple. However, loans from informal sources often carry high and unjust interest rates, which can be a significant burden on borrowers. In case the borrower defaults, lenders from informal sources can take any measures necessary to recover the loan, including legal proceedings. These sources are usually granted for productive purposes only, such as starting or expanding a business, which helps in economic development. Importantly, informal sources are not controlled by any regulatory authority, making them less regulated and potentially riskier for borrowers. Now, moving on to formal sources of credit. These require more documentation, which might take some time, but offers added security for both lender and borrower. The interest rates in formal lending are generally reasonable and justified, reflecting fair lending practices. If a borrower fails to repay, legal proceedings are followed to recover the loan amount, providing a structured and regulated process. Formal sources are typically controlled by authorities like the Reserve Bank of India, ensuring transparency and regulation. These loans can be granted for any purpose, giving borrowers flexibility to meet different financial needs. Understanding these differences helps us see how credit sources vary in terms of regulation, risk, and purpose, which is crucial for making informed financial decisions. Now, let's look at the advantages of formal sources of credit. First off, grants and loans are provided specifically for productive purposes, which means they are aimed at activities that will generate income or contribute to development. This focus helps reduce the chances of falling into a debt trap, as the loans are used wisely and productively. Interest rates are fixed, and these are determined based on the current market and economic conditions. This is important because it means the risks for borrowers are lower, making borrowing safer and more predictable. It's also essential to adopt a judicious policy when it comes to recovering loans. Proper recovery policies ensure that lenders maintain financial health while supporting borrowers in a balanced way. Helping borrowers utilize their loan amounts effectively is another key point. When borrowers use the funds properly, it promotes development and growth, creating a positive cycle of investment and progress. Another benefit is the low rate of interest, which makes borrowing more affordable. All these points highlight the importance of formal sources of credit in fostering responsible borrowing, supporting economic development, and ensuring financial stability. When we look at formal sources of credit, there are some clear limitations we should be aware of. First, there's often less autonomy in how the funds can be used. This means borrowers don't have much flexibility to decide how to allocate the money for their specific needs. Next, many grants and loans are only available for projects that are considered productive by the lenders, and they tend to favor locations far from the borrowers, especially in rural areas. This can make it difficult for local entrepreneurs to access support where they need it most. Another challenge is the long and complicated process involved in securing these loans, which often requires extensive documentation. This can be discouraging and time-consuming for those seeking quick financial assistance. Additionally, it's tough to get small loans for minor financial needs. These formal sources usually focus on larger projects, leaving smaller, urgent expenses hard to cover. Lastly, many grants are only secured loans, meaning that if someone doesn't have proper collateral, they simply cannot borrow at all. This creates a significant barrier for many people without valuable assets. Overall, while formal credit sources are essential, these limitations highlight the need for more accessible and flexible financial solutions for a broader range of borrowers. Loans are granted to meet all kinds of financial needs, whether it's for personal emergencies, business expansion, or other purposes. What's important here is the full or high level of autonomy you have in utilizing these funds. You can decide how to use the money without too many restrictions. Moreover, you're free to choose the loan amount, the repayment period, and the mode of repayment that best suit your situation. The process is designed to be simple, with less or even no documentation required in many cases, making it very accessible. It's a quick and easy process, often enabling you to get instant credit when you need it. These features highlight the advantages of informal sources of credit, which are especially helpful for those who need fast and flexible financial solutions. This ties into the overall theme of understanding different credit sources and their roles in meeting various financial needs. Let's discuss some of the limitations associated with informal sources of credit. One major issue is undue and unnecessary interference in how funds are utilized. This can really hinder borrowers from using the money as they see fit, which can disrupt their plans and growth. Another significant point is that many loans or grants are often given for unproductive purposes. This not only harms the borrower's interests, but can also be detrimental to the overall economy, as resources are not used efficiently. Moreover, the recovery of loans can sometimes involve unjust and unethical methods if the borrower fails to repay. Such practices are unfair and can create a lot of hardship for those involved. There are also tough conditions for repayment, which can make it difficult for borrowers to meet their obligations. Add to that the high rates of interest charged, and it becomes even more challenging for borrowers to succeed in repaying their loans comfortably. All these limitations highlight some of the risks and challenges that come with relying on informal sources of credit, and why it's important to understand these issues as we look at the wider financial landscape. Taking fresh loans to repay previous loans can seem like a quick fix, but it often leads to a debt trap, making recovery very difficult. When we invest borrowed money into high-risk businesses, the chances of failure increase, and so do the risks associated with repayment. If you're unable to repay the loan, the lender might seize the property you've kept as security, which can be a serious setback. Using borrowed money for unproductive purposes, like spending on things that don't generate income, can also worsen the situation. And it's important to remember that delaying loan repayment only adds to the burden, because the interest keeps accumulating, making the total debt even larger over time. When loans are borrowed at very high interest rates, repayment becomes even more challenging, often trapping the borrower in a cycle of debt. Sometimes, credit can turn into a burden rather than a help, especially in these circumstances. So, while credit can be beneficial, it's crucial to understand when it might turn into a liability and lead to a debt trap. Let's take a closer look at the statistical data and their interpretation, which you can find in the book. Now, focusing on India, it's important to understand that both formal and informal sources of credit operate simultaneously. The formal sector, which includes banks and financial institutions, primarily lends to large industrial sectors. This means that big industries and corporate businesses are the main recipients of formal credit. On the other hand, small borrowers such as small farmers, the labor class, small artisans, and small businessmen tend to rely more on informal sources of credit. These informal sources can include local moneylenders, friends, family, and other community-based lenders. This distinction highlights how credit is distributed across different segments of society in India. The formal sector supports large-scale economic activities, while the informal sector remains crucial for the smaller, often more vulnerable, segments of the population. Understanding this balance is key to grasping the broader picture of credit flow and financial inclusion in the country. Now, let's talk about some of the problems faced when borrowing from the informal sector. One major issue is undue and unnecessary interference in the utilization of funds. This means that lenders or other parties may unnecessarily control or influence how the borrowed money is used, which can create complications for the borrower. Another critical point is the risk of failure to repay the loan. If the borrower can't pay back the loan, it might lead to the loss of property, such as land or assets, and this can cause their economic conditions to worsen further. The conditions for repayment are often very tough, making it difficult for borrowers to meet their obligations. And if they do fail to repay, some lenders resort to unjust and unethical means of recovery, which can be very harsh and unfair. Additionally, the interest rates charged by informal sector lenders tend to be very high, adding extra financial pressure on borrowers. All these issues highlight the challenges and risks associated with borrowing from the informal sector, especially for those who already have limited access to formal financial institutions. Let's take a closer look at why small farmers tend to borrow from the informal sector. One major reason is the inability to fulfill the documentation needed for formal loans. Many farmers simply can't meet the strict paperwork requirements of banks or formal financial institutions. Another point is the easy accessibility to money lenders outside the formal sector. These informal lenders are often more readily available and easier to reach, which can be very appealing for farmers in need of quick funds. Lack of awareness also plays a significant role. Farmers might not be fully aware of the formal financial options available to them or how to access them. Poor accessibility to banks is another challenge. Many farmers live far from banking facilities, making it inconvenient or impossible to use formal banking services. Additionally, some farmers borrow for unproductive purposes, which means they might take loans without a clear plan for repayment or future benefit, often due to urgent needs or lack of alternatives. Lack of collateral is also a critical barrier. Without assets to secure a loan, banks are less likely to lend. Illiteracy further complicates matters, as it impairs the ability to understand loan terms or fill out necessary paperwork. Hesitation to go to the bank is common too. Many farmers feel intimidated or uncomfortable with formal financial institutions, which can seem distant or complicated. All these factors together explain why many small farmers prefer informal borrowing, despite the risks involved. It's a combination of accessibility, awareness, and practical barriers that drive this reliance on informal sources. Let's consider the informal sector lending and the interest earned on it. Since these transactions are not taxed, they essentially become black money, which contributes to illegal economic activities. Unproductive loans, in particular, can be misused to finance illegal businesses, further fueling crime and corruption. This situation highlights the importance of protecting borrowers from exploitation by speculative moneylenders. These lenders often charge exorbitant interest rates, trapping borrowers in vicious cycles of debt. Such conflicts between borrowers and lenders can sometimes escalate, leading to critical law and order issues that affect community stability. Most of the borrowers in the informal sector are poor individuals who rely heavily on such financial support. They need protection not just for their immediate needs, but to ensure their rights are safeguarded against unfair practices. So the question is it really important to protect these informal sector borrowers? Absolutely. Providing them with safeguards helps promote financial stability, reduces illegal activities, and supports social equity. Protecting these vulnerable groups aligns with our overall goal of creating a fair and inclusive economic environment. Let's take a closer look at some of the key measures aimed at protecting borrowers in the informal sector. First, we have reserved and compulsory lending specifically for rural and small-scale industries. This ensures that these vital sectors have access to credit, which is often hard to obtain through traditional channels. It also helps foster their growth and sustainability. Next, we focus on making the lending process easier and more accessible. This involves simplifying the documentation requirements, making it less burdensome for borrowers to access loans. The goal here is to reduce bureaucratic hurdles and encourage more small entrepreneurs to seek formal financial support. We also emphasize awareness campaigning. Educating borrowers about their rights and available financial services is crucial. When people understand how to navigate the banking system, they can make better financial decisions and avoid falling into debt traps. Another important aspect is offering flexible loan arrangements. This includes adjusting the size and duration of loans to suit the specific needs of borrowers. Flexibility can make repayment more manageable and prevent defaults. Finally, increasing the accessibility of formal sector lending by expanding the banking network is vital. By bringing banking services closer to rural and underserved areas, we can ensure that more small-scale industries and informal sector borrowers have reliable access to credit. Collectively, these measures form a comprehensive approach to safeguarding informal sector borrowers, supporting their growth, and integrating them more fully into the formal financial system. A cooperative society is essentially a group of people coming together with a common goal of mutual help. Instead of focusing on making profits, their main aim is to develop and support each other's well-being and growth. It's important to note that such societies are registered under the Cooperative Societies Act, which provides the legal framework for their operation. To form a cooperative society, you need at least 10 members. This requirement ensures that the society has enough people committed to its goals. Overall, cooperative societies play a vital role in promoting community development and fostering cooperation among members, aligning perfectly with the broader theme of collective effort and mutual benefit. Now, let's take a look at some common types of cooperatives. First, we have the Farmers' Cooperative Society. This type is primarily formed by farmers to help them access resources, share equipment, and market their produce more effectively. Next, there's the Weavers' Cooperative Society, which supports local weavers by providing a platform to sell their textiles and improve their craft through collective effort. Then, we have the Cooperative Credit Society, which plays a crucial role in providing affordable credit and financial services to members, especially those who might not have access to formal banking. Moving on, the Producers' Cooperative Society focuses on assisting producers, whether they're involved in manufacturing or processing, to streamline their operations and reach larger markets. Lastly, the Customers' Cooperative Society is all about consumers banding together to buy goods in bulk, which helps them get better prices and quality. Overall, these different types of cooperatives highlight how collective effort can address specific needs and improve the livelihoods of their members. Cooperatives build their capital primarily through contributions from their members. This means that each member's investment helps grow the overall funds of the cooperative. Sometimes, these cooperatives also take loans from banks and non-banking financial institutions, or NBFIs, in the name of the cooperative. These borrowed funds are then used either for collective investments that benefit the group or to grant loans to members who need financial support. What's important to note is that cooperatives typically charge very low interest rates on these loans. Their main goal isn't to earn profit like traditional businesses, but rather to improve the economic conditions of their members. This approach fosters a sense of community and mutual support, aligning with the broader theme of cooperative development and social betterment. A self-help group, or SHG, is typically a small group of around 10 to 20 people who live in the same locality. The main aim of forming such a group is to support each other's economic well-being. These groups usually engage in collective business activities or create a fund that they can lend to members in need. This collective approach helps in pooling resources and sharing risks. Additionally, the government actively encourages the formation of SHGs by providing bank loans at subsidized interest rates, making it easier for members to access credit. Overall, SHGs are a powerful tool for empowering individuals, promoting financial inclusion, and fostering community development. The idea behind self-help groups, or SHGs, is actually the brainchild of the renowned economist professor Mohammed Yunus. He's someone who received the Nobel Peace Prize in 1996, and his work has truly transformed how we think about development and financial inclusion. The concept of SHGs was developed in Bangladesh, where it became a powerful tool to reach the poorest communities. One of the most notable success stories from this approach is the Grameen Bank of Bangladesh. It's widely recognized as the biggest success in providing credit to those who need it most, especially the poor. What's remarkable is that most of the borrowers are women, and they come from the poorest sections of society. This model demonstrates how empowering local communities with access to affordable credit can make a huge difference in their lives. It connects directly to our overall theme of inclusive development, showing how innovative ideas like SHGs can foster economic growth and social change from the ground up. Thank you all for being part of this journey. I want to leave you with one final thought. Your criticism and suggestions for improvement are truly valuable. They help us grow and become better in everything we do. Remember, constructive feedback is a gift that pushes us forward. So please, don't hesitate to share your insights and ideas. Your input is what makes a difference. Once again, I sincerely appreciate your time and engagement throughout this presentation. Thank you so much.